The record clearly shows that convertibles have generally done very well in periods of rising interest rates. On a theoretical basis, the embedded option that gives you the right to convert into the underlying common stock benefits from rising rates, but just standing back, often the stock market does very well in periods of rising rates. It may react negatively at the moment when the news has announcements, oh, the Fed is doing this, the Fed is doing that, but step back from the chart and things often go very well. I got my start on the street in 1972. And I lived through a wild bull market from the end of 74 to 81, in which short rates went into double digits. Money markets were yielding in the teens, and yet common stocks trended up in that period, and convertibles did very well. So I see no reason to fear rising rates from convertibles. I'm prejudiced. I've been around convertible securities since the beginning of my Wall Street career in 1972, and I've specialized in it since 1993. And to me, it's the holy grail. It's equity-like returns with less downside risk, with lower volatility. I say you can have as much as you want. This is unrealistic in terms of how investors look at investing, but I should say a significant amount should be in convertible securities. The record certainly confirms that this would have been successful over decades. Market volatility, like rising rates, from a theoretical perspective, means that the embedded option, the right to convert into equities, gets more value in the market. But again, volatility is something that scares people, and volatility is often most pronounced in down markets. So it's especially reassuring that the value of convertibles ought to be enhanced by rising volatility. And if a lower stock market or a lower credit market causes convertibles to go down, they aren't going to go down as much as common stocks. We always have a cushion on the downside, as history shows. It doesn't precisely relate to convertibles, but the reason I hold up this bill is closed-end funds. This is the Closed-End Fund Association, and closed-end funds often trade at discounts from net asset value. And if you can get a closed-end fund at a 10% discount, it's like buying $50 bills for $45. If this were on sale at Home Depot or any place, it would be obviously attractive. And closed-end funds often are on sale. This is a good time to buy. When you get your distributions, they come in whole dollars. You get the whole 50, you don't get only $45 in distributions, even though you only paid $45 for $50 worth of the shares in the fund, in the closed-end fund.